privacy. I'm Romie Goedicke. I work for the UNEP Finance Initiative, where I lead the work on nature-related risk and disclosure. I'm your moderator for this session, which is named Is Nature Finance Feasible? And I hope at the end of the session, you'll all leave this room thinking, yes, it is. So what I'll do is I'll provide some introductory remarks, some households, and then I'll introduce all the speakers. So we're really glad that they're sitting in the right order, because we were joking about that last night. So I think you passed already before saying anything. So we can't solve the climate crisis without looking at nature. And I think one way to be more positive about the steps in climate is looking at biodiversity loss. And I think Sarah alluded to that a little bit already, but research by the world's WWF Living Planet report showed that since 1970, which is a lifetime for many of us in this audience, I expect, we've lost 70% of the population of vertebrates. The IPBES in 2019, so they're the IPCC for Biodiversity and Ecosystem Services, have shown that nearly 1 million species are at risk of extinction. And why is that important for a financial audience? Well, actually, because we see that half of GDP, or my personal take, all of GDP, is dependent on nature. So the State of Finance for Nature report, which was issued by UNEP, showed that there is a 4.1 trillion financing gap. So in this session, we're looking at how we can close that gap by investing in nature, with examples among others from the carbon market, but also what the first step is for financial institutions in more greening the financial sector. So how can you measure your impacts and take action on that? So let's move into the household questions. So we have a jam-packed agenda with lots of interesting questions. So unfortunately, we won't be taking questions from the audience, although, so all speakers will be available after this. So if you have a question or you want to discuss something, you can come to them. Again, all our speakers have wonderful credentials, and I think we have well over 100 years of experience. I would easily say on the two couches, excluding me, obviously. Sorry, we're all joking, so I get confused. But I won't be going through their bios in detail. So if you're interested, you can go to the GEFI webpage and see more about their credentials. So Sarah has been introduced already. I want to move to Kathy Benini, who is Managing Director and Global Head of Environmental Markets, which is carbon markets mostly, at S&P Global. Then we have Alessandra Mongiardino, who is Director of Financial and Strategic Risk at NatWest. Cristof Kutscher, I think you're the luckiest man on this stage, right? You have an all-female panel added up, spiced up with you, so that's great. And you are CEO of the Climate Asset Management, which is set under Pollination and HSBC. So with that said, I think you've listened to me the longest you needed to listen to me already. So let's move to a first question, or a second question, actually, for Sarah. So this morning, Dame Susan Rice said, you know, how can we move more quickly on nature based on the experience we have on the climate space? Could you unravel that question a little bit, Sarah?
Happy to do that. And I might start by reflecting on some feedback that we've got from talking to banks, insurers, investors about nature-related risks, where I would summarize as they're where they were on climate 5 years ago. The sorts of questions that are coming through to us as we talk to them are what is nature? Is it pollination? Is it biodiversity? Is it ecosystem services? So that comment that I made about how broad and varied this issue is something that they're finding challenging. They're asking, how do we separate nature and climate? Or by fixing one, will we fix the other? How do we think about that? They're struggling in the absence of a taxonomy. The TNFD's work will be really important here. And they're struggling in the absence of a target. As I said, what does nature positive mean? Government policy isn't so easily translated into things that they can target. And in that context, they're finding it hard to engage their boards. So I think if those are the things that are the problems, those are the things that we need to address to bring it forward. So it's about taxonomies, it's about disclosure, it's about being really clear what government policy, what good looks like here. And then it becomes concrete and it becomes tangible. And that's what our work, the work of TNFD, the work of UNEP FI, all of us are trying to do. But one thing I would reflect on, when I was here 3 years ago, I was making the case for kind of climate being a financial risk. Look how much progress has been made even in those 3 years. So we're 5 years behind relative to climate, but I'm at least hopeful that kind of doing it for a second time, provided we get those right foundational skill pieces in place, we ought to be able to make progress quickly.
Great, that's wonderful to hear. And the biggest difference is, of course, that nature impacts are always local compared to climate being global. UNEP FI is one of the founding partners of the TNFD as an initiative. And do you see that becoming mandatory in a few years? I'll come to the others in a second. Don't worry, I won't forget about you.
So that'll be for government rather than for us as the central bank and regulator of financial firms to determine. What I can say is the more that we can articulate how these risks are material, the more it becomes inevitable that it should be.
Great, thank you so much, Sarah. So I want to move to you. So part of the inertia maybe on nature might be caused by data or lack of data. So could you explain to you a little bit how S&P Global is looking at those data challenges and making that more feasible for financial institutions?
Thank you, and thank you everybody for having us here. It's great to be part of this great day and among many, many leaders. So on the S&P, I'm going to talk about biodiversity specifically, and then I'm going to talk about more on the carbon markets and the data needed to help facilitate those markets. So in biodiversity, our firm, my colleagues, have joined and collaborated with UNEP, the World Conservation Monitoring Center. And we are combining their GIS data with our facility-level physical risk data to be able to inform our clients. So we're having a pilot that's just about to start. So if any companies are interested in being part of the pilot, please see me after, or my colleague Lauren Smart, who spoke yesterday. And what we're trying to do is overlay the GIS data with physical risk of facilities for companies and allow people to start to learn and question, because you can't fix what you can't measure. So it's really important that we get down this pathway, because if we go forward with the TNFD, you need to have viable data to make assessments. So that's on the biodiversity side. When I heard nature-based solutions, I've been in the carbon, water, biodiversity markets for 14 years now. And as we all know, one of the big nature-based solutions that we need finance for, or continued finance, is REDD and other nature-based solutions. And why is data important in helping us move finance? Well, I'll tell you, I have over 4,000 clients in the space. And when the market started to take off, I had probably 20 banks call me, asset managers, investments. What did they want? They wanted to have an understanding of what is the quality of the projects, and you see the Task Force for Scaling Voluntary Market and the UK Forum Steering Committee, who is trying to help answer what are the elements that allow somebody to feel comfortable with acquiring a carbon credit. We all know that we have big goals to reach by 2030, and many companies are looking at reducing within their company, but offsets or allowance markets are key markets. So what do you need to make a market grow? You need pricing. You need indexes, because if you're going to hold it and create a fund, you need to benchmark yourself against something else. You also need reference data and reference identifiers. These are all basic tools in an equity and fixed income market, but you really don't see them in the voluntary market. And really to scale where we need finance to be is we need this. And you'll see over the last few years, you'll see more pricing, you'll see some benchmarkings. You're going to be seeing carbon rankings have started to come out to help facilitate for corporates what are the choices in what I'm doing. What do I base? What's most important? Quality, performance, or is it all important to me? And the final thing that I just want to talk about is something that I realized at the Paris COP, that we're going to have, each country is going to have their own registry. And I've been in registry infrastructure. So there's going to be 192 registries. And effectively, how do you make sure that something isn't double counted or double claimed? How do you check against all these registries that somebody has not registered the same project in two places? I'm happy to say the last few years I've been talking to markets about this, and I have an advisory board of banks and governments, and we created a meta registry. So we pull in all the data. It's very interesting to see the UK and all the projects that are in the domestic program for the peatland code and the UK woodland carbon code, and to see how they interact with, especially in LATAM, we work with Peru and Chile and all the governments, that they're able to see their own activities alongside private projects. And why is that important? Again, data helps them make good decisions on how to incorporate private projects. So to conclude, data is key. And the more data we have, the better it is to get financing into this much needed space. Thank you.
Thank you so much, Kathy. What you can't measure, you can't manage. That's great. We're going to make a bit of a jump in the topic with Alessandra, really looking into the role of NatWest. So how can NatWest and other banks be more involved in positively contributing to the biodiversity challenge?
Thank you very much. And the first thing I would say is that there are several ways that NatWest and other banks can contribute. But we need to acknowledge that we have a long way to go. And a lot of things I'm going to say really echo, Sarah, what you just said.
Glad to hear, yeah.
We are at the start of this journey, and the way that, discussing this with my team, a few days ago, we said, look, it's really like being at Everest, base camp. And that's so we need to face it. And this doesn't mean that, we don't have ways to tackle it, but just have that humility that we have an awful long way to go. So that's the first thing. So this means that we need to learn and we need to develop tools and data, which also is something that, has already been discussed. So with this premise, there are the three ways that we are looking at, or we are already active, is the first is being involved with the TNFD. Because clearly that's a way to collaborate, and start really in practical ways to look at how we can quantify and then disclose, some of the risks. So, and that is acting together with other institutions and, regulators and the like. And this also means that we need to look at aligning measurement and methodologies, because if we all come up with different ways, then we don't have a common language, and that would be a huge problem. The second thing is around partnerships. So that really we need partnerships to accelerate progress. So we are bankers, we may have different backgrounds, but we don't have many colleagues, with background in nature and climate. So what we need to make sure is that we really work with other institutions, institutions like yours, like the, as well as academia. And I sort of make two examples when it comes to academia. The first is that we are the official sponsor for the Renew project with the University of Exeter that looks at the biodiversity loss in the UK. And also we are partnering with the Cambridge Institute for Sustainable Leadership, and we developed and we published a case study earlier this year that looks at cereal farming and the impact that different risks have on farmers who may have better or lower quality land. And what you actually see that farmers with the lower quality land are much more exposed to extreme weather events. The other point when it comes to partnership is also we are partnering with the Sustainable Food Trust, looking and promoting the Global Farm metric tool. We are actually digitizing that, so there will be an app supporting agricultural firms to assess the impact of their farming practices. Then the third point is around interventions, because now it's like, yeah, you talk to people, you collaborate, but so what do you do in practical terms? And that's where we are really looking at redirecting financial flows to more sustainable business. The one is contributing and supporting firms that are involved in circularity. And you may know that we actually have a pledge of 100 billion sustainable finance, new sustainable finance by 2025. And what I'm saying is incorporating in that. Then is sort of exploring, and again, echoing what Sarah was saying, is the exploring the nature-related financial risk. So looking similar to climate, looking at double materiality. So both the risks that we have in our own operations, as well as the risks that we have in the lending activities. And also, in this space, we completed a pilot earlier this year for our operations in the Netherlands. Then is internally, we have set up the Emerging Environmental Issues Working Group back in 2020. And with that, that led to the consideration of biodiversity loss as one of the emerging risks that then we discussed with our executive risk committee and the board risk committee on a monthly basis. And as I said, we also work with partners in this space. And the final point I would make is also the mention that we are doing further work on transitioning away from harmful activities. So again, here we have extended the list of sectors where we have, restricted, very restricted policies, to the 7 imported commodities that have the highest deforestation risk.
Thank you so much, Alessandra. And I think for UNEP FI, of course, partnerships, is music to our ears. And I don't want to be too self-promoting, but something we're doing is we're running TNFD pilots with nearly 40 financial institutions. I know I spoke to a few people that are interested in that, but we also run the PRB Biodiversity Community, which is a learning setting for anybody in the banking industry interested to learn more about biodiversity and how to tackle that within their organization. So finally, moving to you, Christof. Thank you for waiting for that for so long. So to what extent do you think that nature finance products are dependent on the carbon market, and even maybe taking a step back and explain to our audience, how can we invest in nature?
Good afternoon, everybody. It's an honor and pleasure to be here, and I'm here representing the asset management industry. Before I respond exactly your question, I think there's a lot of consensus, especially in this room, that nature has been depleted. The land is worked in a way which is very intensive, maximizing output. With that, soil has been depleted, and more fertilizer, more pesticides are used, and there's kind of a vicious cycle visible. And nature needs investments, needs capital to improve. So that's one side of the coin. The second part of the coin is what do investors require? And here I talk about institutional investors, because nature is so big, it needs capital at institutional scale. So we need big amounts of money to be invested in this one. And institutions work in certain ways. Of course, they have also fiduciary duties in most cases, so they need to deliver some return to their pensionists or whoever the benefit, on the other side, their clients. They need to achieve that at an acceptable risk. They have not all the time in the world to deliver that, so there's a time horizon they need to consider. And of course, increasingly, they also want to show impact to clients, that their investments also have other positive effects. So that, how can we bring them now together? I think that's the trick. And of course, asset managers provide solutions typically, and investing into natural capital has become a very hot topic, even though it is in its infancy. And again, I have to do a little loop here. I'll give you an example. Whenever we need to get meetings with the investment committee of a large institutional asset owner, we get an invitation very quickly. They're all interested in the very subject. So that's great. And then we need an audience, and this is a real example, a very large institutional European asset owner. And they have the head of asset allocation, you have the head of risk management, you have the head of impact, you have the actuary people, and so on, and the head of private equity. And the first thing is, the head of asset allocation asks us, what is natural capital? Is it an asset class? I have no bucket for this one. I don't know where to put it if I invest into it. Then the person who is running private equity says, private equity, I need 15-20% IRR, otherwise I cannot come in, so it cannot be the private equity bucket. Then the impact person speaks up, say, okay, impact investing, we don't expect really high returns. Why can you have 10% return and still a lot of impact? So even that is a problem. And then the actuary comes, what is the solvency ratio for nature? How do I deal with this? So what I'm alluding to, the industry is very institutionalized, and these prospects were extremely interested in it, and we continue talking to them, but now for 1.5 years, because they have to set up a new asset class, they have to introduce risk management. How do you do risk management as an asset owner for natural capital? So it's a very long process. Not only nature is slow, institutions are also sometimes slow. So let's see how we can accelerate that. So now come to the risk-return riddle, risk-return impact riddle. There are ways to create scenarios, outcomes for investors, which create return at an acceptable risk and impact, positive measurable impact without carbon. I give an example for that one. For example, we are doing a transaction in Southern Europe, an area where trees have been chopped off 200 years already, has been transformed into grazing land. There is water, but they use flood irrigation. The water evaporates in no time. The soil has been completely destroyed by the cattle, which has been there well, not the same, obviously. For 200 years, they've been farming cattle for 200 years. And so the land is in a miserable state. Very often there is no succession, so the next generation of farmers doesn't want to work on a plot of 20 hectares with 12 cows on it, and they move to the cities. There is no succession. So the land is available, the land is depleted, nothing has happened. So what one can do is buy land, be creative in changing land use, for example, and use technology to create something which is sustainable. In this case, we bought the land, started to plant olive trees, introduced drip irrigation with sensors at every tree. Every tree gets exactly the amount of water needed. We reduce water use against the primitive way of the way the land has been worked with by 30% or more. So we need much less water, which is, of course, very good. We introduce cover crops in between. We bring insects back, and the insects bring the birds back, which are nesting in trees we plant there. So the whole thing can create very significant economic return. It requires patience, 15 years or so, to make this whole thing work, because there's a long J-curve. But one can create outcomes which are good for investors, i.e. they get the necessary return. There's an acceptable risk involved in this one, and nature benefits. The land is more sustainable. We can sell it at the end of 15 years to somebody who is then reaping benefits of having better land, which is substantial. In this case, we also absorb carbon because we create a lot of biomass, and the quality of the soil improves a lot. There's carbon soil in it. Current regulation doesn't allow us to monetize this one, so we cannot monetize it. But luckily, this investment works from a risk-return impact perspective also without the carbon. However, we would be able to attract more investors if we could monetize the soil carbon and the biomass we are producing. So it is helpful for us if regulation is changing and these things become possible. In Australia, for example, soil carbon is now an accepted way to produce carbon offsets. So it is there. We only can report to our clients that we have done the absorption, but we cannot deliver the financial return. And if you give me one more minute, I give you the other extreme, and that is investing into what we call environmental assets. Environmental assets create most of their return through ecosystem services, i.e. carbon offsets and possibly biodiversity credit. In Australia, I mentioned there are already some soil credits, and we have Great Barrier Reef credits. So there are a lot of different ways how you can monetize this one. An example of this one was an investment in the Southern Hemisphere. Again, in a very mountainous region, 50 years ago only, all trees were cut off for dairy production, for cattle farming, but also for dairy production, which was exported. There was high demand from China at the time for dairy products. Again, this was very high altitude. It was not really grazing land. And then, of course, the Chinese learned to produce their own dairy products, so that demand shrank. And the result is, of course, we have destroyed land. You have no income anymore. The farmers are bankrupt. Land is available. So in this case, we can buy the land and start reforestation. For reforestation, we get carbon offsets. So in this case, this investment is only possible with carbon offsets. So carbon is a key component in making this happen. So what I tried to do, I gave two extreme examples. One where we don't need it really. It's nice to have and good for investors, and we can attract more investors, and others which we cannot do at all without regulation on carbon, how carbon can be accounted for and can be used. So two extremes. So your question, do we need carbon credits to do investment into nature? Yes and no. but it helps a lot to increase it. And of course, we need to raise much more capital from institutional investors who will be much more willing to do so if they see better risk-return impact profiles.
Thank you so much, Christof. And I think it shows that every project is unique. And I find it interesting also that your examples are both taken from projects where there wasn't a lot of biodiversity to start with. So, I come from a conservation background. I would always be interested to see how can you, invest in nature before you start destructing it. Sarah, I couldn't stop but seeing you nod. So would you want to add to what Christof said?
Perhaps I might emphasize one point, which is the importance of considering how the infrastructure that we build supports the transition to net zero. The voluntary carbon markets can be an important part of that. Disclosure is an important part of that. Taxonomies are an important part of that. Transition plans are an important part of that. And I think those combination together can help make sure that we support the transition to net zero, getting us to the point where we have got plans to get us to net zero. And the interesting thing for me is just how can we try as we do that to make sure that nature is a part of that, not an afterthought or a subsequent issue, but try and embed it from the start.
Yeah, absolutely. So what we often say is that there are two sides of the same coin, and it's only natural that we continue along that road. So, Kathy, would you want to reflect from your experience on Christof's story?
Well, I find it interesting that a lot of the nature-based, and we were discussing this last night, it's not having anything to do with crediting aspects. It really has to do improvement and efficiency of the agricultural processes and the land, which increases the value. But we're asked, because there's a lot of investment going into both the voluntary carbon market, as well as people will see, it's weird if I sit one spot.
Exactly, I know.
It works if I move. So we have the traditional voluntary market, and you're going to see many jurisdictional RED programs coming on because the supply that we need to really meet 2030 is going to need the jurisdictional RED that comes from many of the LATAM and forest nations. So I think that there is some of the methodologies that exist in the voluntary program, but the countries are looking at some of the key components of the voluntary market and sort of identifying, they're following the UNEP RED program. So they need to, interestingly, they want to commercialize. They want to take the opportunity. In the past, a lot of the countries got payment for performance. But they now realize that they have an opportunity to bring in high values and to invest back into their nature. And I've some tremendous programs to just sort of shift an economy. I'm going to take Acre, Brazil. I went in 2015 at the COP. There was many awards given to that program. Why? Because they looked at, a lot of their deforestation was due to cattle. And how do they solve that? Because I think you need, and if there's anybody from the West, they may know better, but 1 acre per a cattle in order to deforest. And how do you reverse that? And how do you still provide protein for the people who live in there? And what they really did was they did private-public partnerships, and they invested in fisheries. So in order to replace the protein, they were innovative in looking at a different way of approaching it. And you only need maybe 1 acre of land instead of destroying 500 acres. But anyway, the importance of what he said is we do need to recognize biodiversity projects and RED needs to have the financing and needs to identify the benefits of those so they can get carbon credits. And that can be part of the financial equation. because the financial occasion lacking a price on biodiversity is very difficult. You know, you can achieve more money if you can show more returns. So that's my end.
Thank you so much, Kathy, also for your persistence with this microphone that's not really functioning as we would want it to function, I guess. So I think we're nearly coming to the end of our discussion, but I want to go back to you, Alessandra, because I'm a very practical person. So I would be interested to hear from you, you know, your recommendations to the banking industry. You know, what can they embark on tomorrow, and how can they have that peer-to-peer learning?
Yeah, thank you. And I think I mentioned earlier that, you know, part is the collaboration, you know, across the industry and then with institutions like yours, scientists, academia, as well as, you know, start learning by doing. So, you know, some of the initiatives that we are doing, you know, with some of our customers is a way that, you know, we can really see and start that process. So, you know, it's not one thing, you know, we need to do a number of different things. And so, you know, that's true for us as an organization which actually has climate, you know, at the heart of our strategy. But, you know, I think it's true across the banking industry.
Great. Thank you, Alessandra. And maybe coming back to you, Sarah and Christof, the head of UNEP FI, Eric Usher, always speaks about this dance between the private and public sector, and sometimes private is leading, sometimes public is leading. Could I ask you both to reflect on these different roles within the nature debate before we wrap it up?
So everything to do with climate change, everything to do with nature involves an awful lot of partnership. We need partnership between companies and households in the real economy and their financiers. We need partnerships domestically and internationally. We need partnerships with the private sector, and we need partnerships with real economy regulators and financial regulators. And we can only move forward together. It's a step-by-step process. Nobody can get too far ahead of the other. And so just to underline Alessandra's point, this is all about partnership. Certainly we are looking to take it forward on all of those dimensions.
Great. Thank you, Sarah. Christof, could I ask you to reflect on the same question?
Hopefully, governments and regulators eventually represent the will of the people. That's always my hope and assumption. And of course, in this context, I don't see a conflict between the two, because there's the government is executing the will of the people, hopefully. And I think that includes also a better world where we have reduced risk from nature. I would like to add one thing, which is not government and not in private, the commercial world. It's communities. Whenever we are doing a carbon project, and carbon projects typically happen in emerging markets because the tropics are more productive in this one, we need to work together with local communities, because in the end we are changing their livelihood. We try to improve their livelihood, but we need to have collaboration. And then it becomes a little bit complicated, because it's local communities, it is local governments, it is government of the country, and investors like us, or intermediaries as asset managers, who need to bring them all together. This can be a very complex exercise, and there are not always the interests aligned, and so that takes the longest part of our negotiations when we implement projects.
Thank you so much, Christof. And I think also thank you to Alessandra, Kathy, and Sarah, the other speakers we had on this panel. So I think I wanted to close off by saying economy and ecology both come from the Greek word oikos, which means our house. And you know, I think somebody earlier today already said, you know, our house is on fire. And I think our house is on fire because we're making a distinction between ecology and economy. So I think we have a unique opportunity at the end of the year with COP15. I'm not using the wrong number because it's the Biodiversity COP that's taking place, to really work on that alignment of financial flows. And I want to thank you all for your attention. I think I'm closing it off on the second, so I think GEFI is going to be happy with us. Thank you so much.